Hello, hello, hello. Hello, everyone. Welcome to today's episode or today's tax talk. Um, Thursday tax talk every Thursday at 11 a.m. Eastern Time, where I give out a few tax tips. I answer a few questions. Thank you for those who participate in the questions by sending those questions in via email. Greatly, greatly appreciate that. This community here is for you to answer a lot of questions, to get to know me, for me to get to know you. We'll be moving this Thursday tax tip will be here every Thursday, but we will be moving this into a Zoom environment. So then that way it's a little bit more private. So if you feel like you want to be in a more private environment where you can really ask those questions, maybe this is a little too public, we could definitely do that. And in that way you get your questions answered. So I'm truly excited about that. All right, we're going to wait just for about a minute or so. Going to let a few people in as they arrive. And while people are arriving, I am going to pull up what I had promised to talk about. And that is one, the major 2025 tax changes to come. And then a few questions regarding the capital gains and capital gains tax. So we're going to go over there for a few questions that came through. Some of these questions, I've taken one question and then I've combined some answers with other questions that are kind of related. So I'm going to definitely share that as well. So we'll give it a few minutes. We'll give it about a minute or so while people join the call. As you join the call, you could definitely put in the chat, good morning, how are you? Where are you viewing from? That is great to know. Super excited to see where our viewers are coming from. Definitely exciting to know about as well. So, yes. All right. Okay. And just waiting in, give it about a minute or so as people join in the chat who are viewing. And then we're going to get right into it. All right, and let's get started. Let's get started. Okay, let me add this here. Okay. All right. Okay, so we're going to start here with the major 2025 tax changes to come. What could happen within this year and how it can impact next year as we start to tax plan. It's always good to tax plan a year in advance. Sometimes we don't do that a lot of times because we're not aware. And so sometimes we're trying to play catch up. So we're tax planning within the year and then we're trying to forecast for the next following year, which is fine. They're all great. It's a great approach. It's never too late until you get to the end of the year and then you're trying to play catch up. That's when it really gets too late. But excuse me, guys. But for the major 2025 tax changes to come, the House is expected to vote on the tax and spending bill. They say by next week, and they're aiming for a final pass on that vote to pass through both the House and Senate by July 4th on Independence Day. Okay, they're going to do that. So, what is in this tax and spending bill, which is often referred to as, and you probably heard on the news, the big beautiful bill? Well, one, the biggest the biggest news about this bill is that uh, this bill is looking to extend the 2027 Tax Cuts and Jobs Act provisions. Now, this bill, now what's in it to extend is to extend the standard deduction. So you know how we've been getting this huge lump standard deduction. A lot of taxpayers can't itemize because of how big the standard deduction is. And then for those who can, that's great. But this really allows those who may not own a home or have a very low tax base. If they do own a home, they're not paying as much in state taxes for like property tax, and may not pay a whole lot in state taxes because they don't live in these big, huge state tax, these huge states that have a big tax rate. Generally don't qualify, but still, the standard deduction, huge, 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 and the 20% deduction for the qualified business income under section, what they call it, 199A. You guys probably didn't know that, but it's called the qualified business income deduction. That's the 20% deduction that you get on net profits from your partnership, your S corporation, and or your single member sole proprietor business. And for those that are real estate investors and you materially participate and you have a profit, and there's some provisions along where you can actually qualify for the 20% deduction. It is for the net rentals as well. Okay. So my question is what I'm thinking that you guys probably have in your mind is what measures will be extended outside of the standard deduction and 20% QBI deduction, right, which is the qualified business income deduction. Well, the big player is the bonus depreciation. See, the tax bill proposes to reinstate the 100% bonus depreciation for qualified property acquired and placed in service after January 19th. So on the day of Trump's inauguration and through December 31st of 2029, business owners will be able to write off 100% of qualified property that they've acquired starting this year. Okay, so that's a big deal. That is in the tax bill. For assets that are used for like long, production. So if you have an asset, mainly in the construction industry where you're using this asset and it's for a longer production period where these jobs are like 2 years out, and you have to use this property over that period of time. This extension goes out to you guys all the way through December 31st of 2030. Okay, so so you get an extra year. And this also goes for specific aircraft. Now, they didn't give details on what type of aircraft, okay, but they just said, if it's used for business purpose, then, you'll be able to do the 100% bonus depreciation on an aircraft. I think that's amazing. It's almost like the Trump administration again just took depreciation and threw gasoline on it. The next provision or the next proposal of this provision is the estate tax exemption. So the estate tax exemption would increase to 15 million per individual. This year, it is at 13.61 million, effectively reducing the number of estates subject to tax. So this is super important, and we can have another discussion on maybe next week or the week after Thursday Tax Talk to really talk about the estate planning and why that's like super important. Why we want to consider this exemption and how it would definitely help you and those who are going to benefit from your hard work. Is going to also save them in taxes. This is super huge. Okay. The next is the child tax credit. So this is a good one. Everyone loves the child tax credit. They did not propose a income threshold last year. I think it was, if your income was $400,000 or less, you qualify for this child tax credit. I am not reading anything under this new proposal that suggests that. If it does, I will definitely come back on air and talk about, hey, it's actually here, but I haven't seen it yet. It just basically says that that this bill proposes to raise the child tax credit from the $2,000 per child to now $2,500 per child for starting in this year of 25 through 2028. So after 2028, it's going to revert back to $2,000, and then it's going to be annually adjusted based off of our inflation rate. So that's what they're proposing. Another big deal for the major changes that are coming down the pipeline for this year and going forward all the way up until 2028 is the SALT deduction cap. So you're probably like, what's SALT? SALT is the state and local tax deductions. Okay, big states like California, New York, Arizona. What other big tax states do we got where the tax rates are they're just huge? Maybe Georgia. There's a few other states, right, where you may, so the current bill for these states, and I want to stay focused on that, they have a high tax rate. And so if you own property there or if you work within that state, you pay a lot in taxes at the state level. Well, back when the TCJ 2027 reform bill was passed under the first Trump administration, in order to get this bill passed, they had to do some spending cuts, and one of the cuts was that they capped SALT deductions to $10,000, right? So a lot of people didn't like that. A lot of states didn't like that. They felt like that was deterring people from moving, to their states, and there was just a whole lot of political uproar behind that. But now, after kind of getting a lot of that feedback, it looks like they're proposing to still keep a cap on there. Before, I don't think it was much of a cap, and if there was, it was subject to like alternative, the alternative tax, AMT. I'm so sorry. I can't think of what the act. It's the AMT tax. It's the wealth tax. It's not a wealth tax, but for high income earner tax, where it kind of reduces your deduction and kind of slaps on like an additional tax. A lot of people don't like that either. But so what they did was they put a cap on this, and that cap basically increases to $30,000, right? And of course, this will phase out at the beginning of your adjusted gross income hitting $400,000 or more. Okay, so this will phase out. Okay, so if you're under the $400,000 mark, as far as your adjusted gross income, you will get the $30,000. That's the max SALT deduction. So those are some pretty cool things that are coming down the pipeline. Now there have been some new proposals added to this extended tax bill. You might have heard a little bit about it. There's been some back and forths on it, but nothing's etched in stone yet, because in order for them to do this, they have to do a reconciliation of the spending bill in order to fit these new deductions in here. So these are some things that they are strongly considering and wanting to move forward July 4th if all is well and everyone gets along and it votes through. Okay, so that is going to be the elimination of taxes on tips and overtime. So that was like a big deal. So they want to eliminate taxes on tips and overtime. So this will be exempt from federal taxation only. So at the state level, we don't know if state is going to adopt some of these changes, if they're going to conform, or if they're going to say, hey, we're not conforming to that. But at least at the federal level, this would be enacted for years 2025 through 2028. Then we have the senior bonus deduction. That's a new one. I haven't even heard of this one. So this is the senior bonus deduction. It's a new $4,000 deduction for taxpayers age 65 and older. So you get an additional deduction as a standard deduction. Okay. Now this phases out for individuals earning over $75,000. Okay. And for Mary Fallon Joint, over $150,000. So that's one of the big deals there. Then we have this proposed MAGA savings account. It's called the Make America Great Again savings account. Now, this is supposed to be a government seeded account where the government gives you $1,000 for opening this account for your child born between the years of 2025 through 2028. Okay. And this also allows you to contribute up to $5,000 annually. Now, I haven't seen anything in etched in stone just yet. It's still a proposal on whether or not they're going to allow that $5,000 to be excluded as or deferred rather, and that it just grows into your child's account. It is a savings account. It's not a retirement account or nothing like that. The child certainly doesn't have to earn anything, but this is great. I mean, if this kind of works like a Roth IRA, where in a Roth IRA, you have to have earnings, but this is just more of a savings account where you could just move the money in there. It just says that the government's going to give you $1,000 and then you could contribute up to $5,000. So that's a total of $6,000. If you could do that and they allow you to take that $5,000 and have it be a deduction to some degree, where this looks a little bit more pre-tax, but then it just grows in a free tax way because it's sitting in a savings account. I don't know if this is going to be backed by bonds or whatever. I mean, there's just so much to unpack on this savings account. So if that all happens, I mean, this is a big win. This is a big win. I mean, it doesn't say anything about being subject to a kiddie tax or anything else like that. Because now when you try to move money to investments for your kids, you get hit with a kiddie tax based off of your tax rate. So if you're at a 37% tax rate and you move money into your child's investment account, that money is definitely going to be taxed at 37%. So this right here seems to shield a whole lot of it cuts a whole lot of tax, especially if you have the discretionary income to start moving money to your child's savings account. You don't have to worry about all these additional taxes that we currently have in play right now. So I think that's a really good one. Then we have the auto loan interest deduction. So they're bringing this back. This used to be around, I think, prior to Reagan days. And then during that reform, I think it was the 1986 tax reform, was a big major bill. They removed the auto loan interest deduction. So now they're bringing that back, but they have it capped at $10,000. So if you purchase a vehicle, and there's some stipulations on this. If you purchase a vehicle and it has a loan, and that vehicle was domestically assembled, mean it was assembled here in the United States. I guess it doesn't really matter where the parts come from and all of that. I mean, it's just very blanket information here, guys. So I'm sure that there's going to be a lot of information that's going to come out that is going to say what is considered domestically assembled. Does this include certain parts, blah 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 blah, or whatever. But if it's assembled here in the United States, and you so happen to have an auto loan on this, you can deduct up to $10,000 in interest. Now they're saying that income is going to be a factor. So as wherever those income levels that they're going to determine that they haven't really released yet, they're going to say, hey, once you hit a certain cap in income, this deduction is going to phase out, meaning that you're going to get less and less and less of that deduction. Okay. So those are some of the major changes, or not changes, but added tax provisions in the extended TCJA of 2027. And again, that is set to pass the House and Senate by July 4th, 2025. All righty. So let me check in here into the chat, see what we got. All righty. I do have my questions here that you guys have raised, so we're going to go through that as well. All righty. So, all right. So, again, I'm going to be answering some questions regarding capital gains and the tax consequences that surround them. And I'm going to read off a couple of questions so we don't go out of time. I usually hold this about 30 minutes, but we're probably going to go slightly over time, just a little bit, just to kind of get through some of the questions. Some of the questions were very related, so I have two that kind of covers a lot of you guys' questions that kind of came in, and then I'm going to give you some tax tips around it in terms of what you could do. I do want to put a disclaimer out here is that we're not giving absolute tax advice. You do have to actually call in and schedule a time to actually talk with one of our advisors, or you challenge your advisor to find out what's best for you. Here's just going to be in general. I'm going to share some information in terms of how it applies to your questions, and then you take that information and you kind of build upon that. Okay, so question one that I received, it says, I just received a large payout from a startup I helped build. Are there any strategies I could use to avoid paying a huge capital gains tax bill? Absolutely. Thank you so much for your question. Yes, there is. If the asset, which could be like a stock that has been paid out to you in cash, can certainly be excluded. And I want to go down that path in terms of how it could be excluded. So you can do like an exclusion. There is a strategy and a rule, a IRS rule and revenue ruling that allows for this to happen. It's called the qualified small business stock exclusion. And that is a tax benefit. It's actually under Section 1202 of the Internal Revenue Code that allows eligible investors to exclude up to 100% of capital gains from the sale of qualified small business stock. Now, there are certain conditions that have to be met in order for you to actually apply this. But yes, there is a way where you can completely exclude capital gains. Okay. Now, to qualify for something like this, this is a great tax tip. First, the stock must have come from a C corporation. All right. So that's number one. Two, the business must have less than 50 million in assets at the time the stock was issued. So whenever the stock was issued, in total assets, that's cash, equipment, receivables from wherever, other businesses that have been acquired, whatever that asset value is, all of it has to be less than 50 million in assets. Okay. The stock would have to have been held for 5 years. 5 years, super important. And the company must be engaged in an active business, not an investment or service related field. So, like, let's say, for instance, you own a financial uh, service company. It's kind of service related, and you do investments. Let's say that you're a licensed broker, and all you do is, give investment advice, and you manage. You're paid based off of assets under management. This do not apply to you. Okay, so if you just recently been paid out and you sold your financial company, this is not going to apply to you. This applies to those who have an active business. Okay. So I just wanted to give that example. Now, the total gain can be excluded, but there are some provisions there as well. It says you can exclude up to $10 million, or it's the greater of. So it's the greater of 10 million or 10 times the adjusted basis of the stock, whichever is greater. You can exclude up to that. So that's huge. This exclusion is super. It's like it's big, right? And a lot of us do not think about this when we're starting up the company. When we are early adopters of a company and we have employees, we're not setting up these structures at the very beginning. And so this is super important to, be able to qualify, because, maybe one day you might sell the company to a larger company, and you're ready to maybe retire, or you just want to, come out of the entire industry. So you never know. So that's my tax tip on that question. Another question that came through is I've got some stock that's done very well. So this is question number 2. I've got some stock that's done very well, but I'm nervous about selling because of the capital gains hit. Are there any smart ways to manage that? Great question. Have you guys heard of the tax loss harvesting tax strategy? So this strategy basically offset gains with losses. Exactly what it does. Harvesting, tax loss harvesting. A lot of your financial advisors know about this, because this is kind of how they manage your accounts. They're looking to see, what you should buy and sell. What is your position, your gain position or not. They send you a statement. It tells you what your unrealized meaning it hasn't happened yet, your unrealized gain and unrealized losses, so you can make decisions, right? So you get these monthly statements. So this is a great way to kind of figure out what that's going to look like for you. All right, so what is it? So tax loss harvesting involves selling investments that are currently worth less than what you've actually paid for, to realize a capital loss. Then you take those losses that because you're going to sell those at the loss, and you're going to offset them by those huge capital gains, which effectively reduces your overall gain that's going to be subject to tax. Okay. Now, I think one of the cool things about capital gains tax is that it sits on a preferential tax rate. meaning, income from zero to about $95,000 to $96,000 is a zero tax rate for capital gains. Anything above that, all the way to, and I think this was like somewhere close to like $700,000 or more, is 15%, and then anything beyond that is 20%. That number may just go up even more. We'll see, or that tax rate they may just get rid of the 20%, but I haven't really heard any much more talk around that. So just want to be very, careful on that. But yeah, so that's what that is. So effectively, it reduces the total capital gains tax when you offset them. So if you got stock that has significantly appreciated, right? It's just very, very high up. Selling it, again, selling it, you want to sell it against a underperforming asset that you have to completely offset it. All right. So that's tax loss harvesting. Now, it doesn't all have to be in like one brokerage account. Okay. It can, you could definitely say, I'm going to sell this at a gain, and then I've got some losses from, business or what have you, that I can offset as long as they sit in a passive position. Okay, so that's super important to know. All right, so here's an example. You sell stock A and you realize a $50,000 gain, and then you sell stock B and you have a $20,000 loss. Net gain $30,000. Kind of get the picture. All right. So now here's the kicker about this. If capital losses have limitations. So if you don't, have enough losses to fully offset the gain, that's great. But let's say that you have more losses than gain, right? Then in the next in the next year or going forward, right, you could deduct up to $3,000 in capital losses against your ordinary income year after year. It just carries over. So the unused losses would just carry over. So this is in the case where you have, again, capital losses that exceed capital gain. Anything to offset your ordinary income is going to be up to $3,000. That's it. Boom, 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 boom. All right. That's what we have there. That is all I have on my questions and a few tax strategies. Again, we ask that you please like, share, and subscribe. I always like to say, every time someone subscribes to our page, an angel gets their wings. Totally not true, but you will receive some tax tips for you to save in taxes. So with that being said, thank you for joining me on today's live, and see you again next week, Thursday at 11 a.m. Eastern. All right. Thanks.